Understanding and managing exchange-traded notes, ETNs, involves grasping their structure, risks, benefits, and considerations for investment. Here's a guide to help you navigate ETNs effectively. Understanding ETNs. Structure. ETNs are debt securities issued by financial institutions, typically banks. They track the performance of an underlying asset, index, or strategy, such as commodities, currencies, or equities. Return mechanism. ETN returns are linked to the performance of the underlying asset or index, minus fees and expenses. Investors do not directly own the underlying assets but receive returns based on the issuer's promise to pay. Maturity and redemption. ETNs have maturity dates, upon which the issuer pays the investor the principal amount. They can also be redeemed early, typically at market prices. Benefits of ETNs. Diversification. ETNs provide exposure to diverse asset classes or strategies, including commodities and foreign currencies, without holding physical assets. Liquidity. ETNs trade on major exchanges, offering liquidity similar to stocks. Investors can buy and sell ETNs throughout trading hours at market prices. Tax efficiency. ETNs may offer tax advantages compared to traditional investments like futures contracts, as they do not distribute annual income but rather defer taxes until sale or maturity. Risks of ETNs. Credit risk. ETNs are unsecured debt obligations of the issuer. Investors are exposed to the credit risk of the issuer. If the issuer defaults, investors may lose their investment. Market risk. ETN prices fluctuate with changes in the underlying asset's value. Market volatility can lead to significant losses, especially in leveraged or volatile assets. Liquidity risk. Although ETNs trade on exchanges, liquidity can vary. Thinly traded ETNs may have wider bid-ask spreads, impacting execution prices. Tracking error. ETNs may not perfectly track the performance of their underlying index or asset due to fees, expenses, and market factors. This tracking error can affect returns. Due diligence and research. Understand the underlying asset. Research the asset class or index tracked by the ETN. Understand its historical performance, volatility, and market dynamics. Issuer creditworthiness. Assess the credit rating and financial stability of the ETN issuer. Higher-rated issuers typically pose lower credit risk. Fee structure. Evaluate the fees associated with the ETN, including management fees, tracking fees, and redemption fees. High fees can erode returns over time. Monitoring and management. Regular review. Monitor the performance of your ETN holdings regularly. Stay informed about changes in the underlying asset's market conditions and the issuer's credit profile. Exit strategy. Define an exit strategy based on your investment goals and risk tolerance. Consider selling or redeeming ETNs if market conditions or issuer risks change unfavorably. Tax considerations. Consult with a tax advisor to understand the tax implications of holding and selling ETNs. Tax treatment can vary based on holding period, gains, and losses. Diversification and risk management. Portfolio diversification. Integrate ETNs into a diversified investment portfolio to manage overall risk exposure. Balance ETNs with other asset classes, such as stocks, bonds, and mutual funds. Risk management. Employ risk management techniques, such as stop-loss orders or position sizing, to limit potential losses from ETN investments. By understanding the structure, benefits, risks, and management strategies associated with ETNs, investors can make informed decisions and effectively integrate ETNs into their investment portfolios. Conduct thorough research, assess risk tolerance, and stay vigilant about market developments to optimize investment outcomes.